Hello Apex entrepreneurs and welcome to this video. Today we're going to talk about The Intelligent Investor. This book is considered to be the #1 book ever written about investing. It was written by a former Columbia Business School professor called Benjamin Graham and first published in 1949. The most successful investor in the world and American business magnate Warren Buffett says that this book has not only changed his investment philosophy but also changed his whole life. In this video, we'll go through the most interesting teachings of this book in a compelling and, of course, funny way. If you watch this video till the end, investing will become an easy game for you, almost as easy as subscribing to this channel and hitting that like button. We publish a new video every Wednesday, so save the date and stay tuned. So, the first takeaway from this book is that saving is for the poor, investing is for the rich. But why? Because if you just put your money into a savings account and just sit there watching it while time passes, your purchasing power will deteriorate year after year. To illustrate this concept, Graham shares a joke by American comedian Henny Youngman. Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. So Mr. Youngman is being sarcastic here. What he meant is obviously that $10 could have bought you many more goods 20 years ago than today. Let's take a real-life example. If you have $10 right now, you can buy 1 burger, right? But do you know how many burgers you could have bought with $10 20 years ago? 2 burgers. And that's what we call inflation. Inflation will eat your money, slowly, year after year, if you keep it in a savings account. Do you want your money to be eaten? I bet you don't. So, don't put your money in a stupid savings account. Invest it wisely and you will be a winner. Now, let's move on to the second takeaway from this book. The price of a stock could be very different from its real value, and here lies the opportunity. To illustrate this principle, let's meet Mr. Market. Every day, Mr. Market visits every company in the world and assigns a price for each one of them. Mr. Market could visit Tesla and give it a price of $500 a share. Next, he visits Facebook and gives it $200 per share, and so on. But the price Mr. Market assigned to every company could be very irrational, because the price is driven by supply and demand. The more there is a demand on a certain stock, the more Mr. Market will assign this stock a better price, and vice versa. But supply and demand are directly related to human behavior, whether they are institutional investors or regular people. And humans could take irrational decisions based on emotions, because emotions are driven by panic, euphoria, and apathy, rather than fundamental analysis. That's why the price of a stock doesn't necessarily reflect its real value. Let me give you an example. Let's consider a company based in the USA. Earnings of this company have been growing at an impressive rate of 30% every year for the last 10 years. Logically speaking, its share price should increase. But what if at some point there's a mysterious and easily transmittable illness that has developed overseas that is spreading all over the globe and threatening our lives, like what happened in early 2020? Investors might get scared of a huge crash, so they sell their shares. And when this happens, we could witness a huge drop in the prices of all stocks, including the stocks of the company we have just talked about. In this case, the value of the company is increasing and its stock price is decreasing. It can happen, and if it did, you should immediately buy stocks in this company. The underlying value of a company doesn't vary dramatically from day to day. That's why daily fluctuating share prices should be largely ignored. So, you should base your buy and sell decisions on your own analysis of the company's business prospects, rather than the short-term movements in the share price. So, in order to succeed in investing, you should invest in undervalued stocks. To put it more simply, you should invest when the price of a stock is less than its value. And we can determine the value of a stock according to a formula given by Benjamin Graham. The value of a stock is equal to earnings per share times 8.5 plus 2 times expected annual growth for the next 7 to 10 years. So, using this formula, you can calculate the value of a stock, and if you found that value is greater than the actual price, then it's a good catch. But you should also note that according to Graham, you should consider a margin for safety. So if the price of a stock is $99 and the value of the stock is $100, then it's not that interesting to buy. You should take a margin of safety according to your risk appetite. We usually take a 20% safety margin. So if the value of a stock is $100, the price should be lower than $80 for us to buy. Although Graham's formula is considered one of the greatest methods to value a stock, it doesn't take into account today's market conditions. That's why a lot of investors use a revised formula, inspired by the original one for their valuation these days. But that subject's very technical and we'll not be tackling that today. And I bet not all of you are big fans of math, and I don't want you to hate me by talking about lots of formulas and numbers. So I'll move quickly on to the third takeaway of this book and see which companies we should invest in. But before starting with this, why don't you try to do a good deed to your closest friend by sharing this video with them and helping them learn how and where to invest. So, according to Graham, there are two types of investors: passive or defensive investors and active or enterprising investors. Defensive investors are regular people who don't want to make a serious commitment in time and energy. They just want to grow their capital in a simple and safe way. Enterprising investors are people who are ready to put a lot of work on the table to become a great investor. So it depends on your personality and on the amount of time you are willing to devote for investing. A defensive investor usually seeks simplicity and invests in safe stocks or index funds, and his aim is to make a decent but not excellent return on investment. On the other hand, an active investor invests a lot of time in research but seeks big returns. Most people are better suited for the defensive strategy because the time they are willing to dedicate to investing is limited. Benjamin Graham advises the passive investor to create a portfolio with a mixture of bonds and stocks. Because when a crisis happens, a lot of people rush to buy treasury bonds. That's why in times of crisis, the price of American treasury bonds increases. Bonds are considered as a hedge in difficult times, so you should always have at least 25% of bonds in your portfolio. For the stock component of the defensive portfolio, Graham gives 8 valuable criteria. 1. Invest in large capitalizations. A smaller company is generally subject to wider fluctuations in earnings, while a large company is generally more stable by comparison. Graham recommended that an industrial company should have at least $100 million of annual sales. So, adjusted for inflation, an industrial company should generate at least $700 million of annual sales in today's value. 2. Diversify your stocks. Don't put all your eggs in the same basket. Invest in 10 to 30 stocks. That should be enough. And make sure that you're not choosing all your stocks in the same industry, because one day that industry could suffer and this will push your portfolio down. That's why you should invest in multiple industries. 3. Invest in companies that have a sufficiently strong financial condition. According to Graham, a stock should have a current ratio of at least 2. A current ratio is equal to current assets divided by current liabilities. The current ratio can be used to measure a company's liquidity or ability to pay off short-term debts. The higher the current ratio is, the better it is. 4. Earnings stability. Companies that can maintain at least some level of earnings are, on the whole, more stable. So the company should not have reported a loss over the past 10 years. 5. Dividends. The company should have a history of paying dividends on its common stock for at least the past 20 years. This should provide some assurance that future dividends are likely to be paid. By the way, if you want to know more on how to make passive income with dividends, we've prepared a full video on this topic. All you have to do is click here. 6. earnings growth. The company's earnings per share should have grown by 33% in the last 10 years, which is almost equivalent to a growth of 3% per year. 7. Moderate price to earnings ratio. The PE ratio should be less than 15, which means that the price per share must not be worth more than 15 times the earnings per share. 8. Moderate price to book ratio. According to Graham, the PB ratio must not exceed 1.5, which means that the current price should not be more than 1.5 times the book value. Now, I know that some of these ratios might not be familiar to you. So, if you want to understand all about these ratios and learn how to value a company and which stock you should buy, we've got 2 complete videos on this subject for you. All you have to do is click here and watch them. So now we've seen the criteria that a passive investor should follow. Let's move on to look at the criteria for an active investor or an enterprising investor. And here we quote Graham himself. The determining trait of the enterprising investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort in the form of a better average return than that realized by the passive investor. The criteria for an enterprising investor are similar to the ones of the passive investor, but they are a little loosened, which allows the enterprising investor to consider more companies. Let's take a look at those criteria. Graham still advises against small undervalued companies, given that they may not be able to sustain themselves through an unstable or adverse market. An active investor should look to companies that have more than $500 million in annual sales. In terms of diversification, you are not required to buy 10 to 30 stocks. 3 to 10 stocks will be sufficient. The current ratio should be more than 1.5. In terms of earnings stability, the company's earnings per share should be positive for the last 5 years. Concerning dividends, Graham only specified that firms pay some level of current dividends, rather than the 20 years required for the defensive investor. Concerning the earnings growth, last year's earnings should be more than those of the 5 previous years. In terms of the PE ratio, Graham left this criteria for the investor to choose. And finally, the price to book ratio should be less than 1.2, instead of 1.5, which is a more restrictive criteria. So, as a conclusion, in this book, Graham explains in depth his philosophy of value investing, which shields investors from substantial error and teaches them to develop long-term winning strategies. We really recommend you read this book, and of course you can find its link in the description. And before leaving, we invite you to visit the description below, where you'll find many resources to help you make money from the comfort of your couch. You will find the books that we recommend to help you acquire the right mindset for success, a free video course that will teach you how to generate passive income, and how to create a 6-figures online business, and much more. That's it for this video. If you enjoyed it, don't forget to share it with your friends, and smash that like button to help us with the YouTube algorithm. By the way, if you're still here while the music is running, here are 2 videos that you'll love watching. The first one will show you the one thing that rich people buy that poor people don't, and the second one will show you how to make millions when the stock market crashes. Just click on either one of them on the screen right here.